The limited liability company, LLC, S Corporation, S Corp, and C Corporation, C Corp, are all business structures that you may be considering. The LLC is a low-maintenance legal entity that's best for a simple business. An S Corporation is a tax status created so that business owners can save money on taxes. A C Corporation is a more complicated legal entity that's best for businesses looking to keep profits in the business. We're going to break down and explain these business structures as clearly as possible with information the typical small business owner needs to know. What are the differences between an S Corp, LLC, and C Corp? Among the many forms of business structures available, most businesses are operated as an LLC, limited liability company, or a corporation. If a corporation is chosen, there is a further choice of whether to be taxed as an S Corporation, if the corporation meets the restrictions of Subchapter S of the Internal Revenue Code, or a C Corporation. If an LLC is chosen, there is a further choice of whether to be taxed as if it was a sole proprietorship, if it has one owner, or a partnership, if it has two or more owners, an S Corporation, if it meets the restrictions of Subchapter S, or a C Corporation. When compared to each other, each one enjoys both similarities and differences. As a rule of thumb, the LLC is the most flexible of all of the business forms when it comes to deciding how it will be managed, and how the owner's financial interests will be split up. It's also more flexible in how it can be taxed for income tax purposes, as it can elect to be taxed as an S Corporation or a C Corporation, rather than as a partnership or sole proprietorship, while a corporation cannot choose to be taxed as a partnership or sole proprietorship. Often an LLC will enable more tax-advantaged transfers of ownership interests to family members. On the other hand, it can be easier for corporations to obtain outside funding, as some investors and banks prefer to invest in corporations than LLCs. Also, if you plan on attracting venture capital or doing an initial public offering (IPO) in the future, a corporate business structure could be a better choice. If that is the case, you should also let the corporation be taxed as a C Corporation. IRS rules, among other things, limit the number and type of shareholders an S Corporation can have, which can make it unavailable for venture capital or IPOs. Deciding in which state to form your business entity. In addition to choosing your type of business entity, you'll also need to select the state where you'd like to file to form your business entity, also known as your domestic state, formation state, or home state. Many business owners choose to file with the state where they live and are doing business. But you don't have to. You can choose any state in the nation as your formation state, regardless of whether you reside or do business in that state. For example, many businesses choose Delaware, or another state well known for its favorable business environment. If you form in Delaware and are doing business elsewhere, you'll need to also register or foreign qualify in the state where you're doing business, typically the state where you live. LLCs, S Corporations, and C Corporations offer limited liability. LLCs and corporations offer their owners limited liability for business debts. It doesn't matter if it is a C Corporation or S Corporation, as that only affects the corporation's taxation. Limited liability helps protect an owner's personal assets from being used to pay business debts, but not if you co-sign a business debt in your individual capacity. Business assets are subject to business debts. Personal assets are subject to personal debts. LLCs are commonly thought to offer somewhat stronger protection, although it depends on the situation. Company assets, example, computer, business bank account, and receipts, and the owner's personal assets, example, family home, are separated. There's effectively a wall, or a veil, or a shield, or similar term, between the two types of assets. In limited cases, this corporate veil might be pierced, example, if the owner failed to treat the business as a separate entity or used it to carry out a wrong or injustice. Although forming an entity is a necessary first step to obtain limited liability, how you run your business matters as well. It's important to keep business and personal assets separate, follow corporation meetings or other formalities, and keep a company in good standing. Sole proprietorships and general partnerships put personal assets at risk. An individual operating a business as a sole proprietor doesn't need to file any forms to create the sole proprietorship. An individual in business as a sole proprietor owns all business assets as an individual and is personally liable for all the business debts. As a business, a sole proprietorship still has to comply with other business filings. For example, if you do business under a name other than your name, called an assumed or a DBA name, you may have to complete a DBA, doing business as registration, or obtain a home-based permit or other business licenses or permits. A significant downside to operating as a sole proprietor is that the business owner has unlimited personal liability for business debts. And, if the business has employees, the owner is also liable for acts of employees. A general partnership involves 2 or more co-owners, instead of just one owner, who carry on a business for profit. Like sole proprietorships, general partners have unlimited personal liability. Other types of partnerships, like the limited partnership, LP, limited liability partnership, LLP, and limited liability limited partnership, LLLP, offer limited liability. Although in an LP, only the limited partners have limited liability, the general partners do not. However, LLCs and corporations are more popular today than these other forms of business. Considering tax advantages. If protecting your personal assets from business liabilities is the only goal you hope to accomplish by creating a separate business structure, then any of the big 3, LLC, limited liability company, S Corporation, or C Corporation will do the job. However, most business owners also want their company structure to provide them with tax advantages. For this reason, the pass-through tax advantages of the LLC or the S Corporation are viewed as particularly appealing. What is pass-through taxation? Pass-through taxation means what the name implies. Profits are not taxed at the company level. Instead, profits, losses, and other tax items are passed through to the owners, reported on the individual's tax returns, and taxed at the individual's tax rates. Pass-through taxation eliminates the specter of dividend income being taxed on both the corporate tax return and on the shareholders' individual tax return. Although pass-through taxation can be an advantage, that is not always the case. Many factors, including the individual and corporate tax rates, determine whether it is better for the LLC or corporation to be taxed as a separate entity or a pass-through entity. It is also important to recognize that while taxation as an S corporation and taxation as a sole proprietorship/partnership both offer pass-through taxation, the tax rules are different. Therefore, an LLC that wants pass-through taxation may also take into consideration whether it is better off, from a tax standpoint, being taxed as a sole proprietorship/partnership or an S corporation. Is there a best choice among LLC, C Corp, and S Corp? When selecting your business structure, if you ask yourself the question, will this matter to me in 5 to 10 years? The answer will almost always be yes. The type of entity you choose for your business affects taxes, day-to-day management, ultimate control, financing, exit strategies, and many other aspects of your business. Usually, but not always, the differences help narrow down your choices in determining which form is best for your unique needs and business. The value of professional advice early on often pays for itself, many times over, by saving both money and headaches as your business grows. Talk with an experienced, knowledgeable advisor, attorney, or accountant at the outset about which type of business structure best serves your unique objectives and goals. Out of all these 3, an LLC is the easiest one to set up and register. Now, let me show you how you can easily form an LLC under 5 minutes using InkFile. InkFile is one of the best companies out there to help you form your LLC. You can click on the link in the description to get access to this deal. InkFile is one of a kind as it offers a free package with services such as preparing and filing your articles of organization. Well, you still have to pay $237 for the state fees, which you would have to do anyway if you chose the DIY option. But looking at the bigger picture, all other companies will still charge their service fee on top of state filing fees. InkFile does not collect this fee. This plan already includes a free registered agent for your first year of subscription, and $119 annually moving forward if you decide to continue the service after the first year. IncFile's next packages are the Gold and Platinum packages, which both have package fees, already on top of the $237 state fee. Each package has its own set of services which are all worthy of the subscription you are paying for. The Gold package offers you the benefits of filing reports and taxes for your LLC. Every year, USA LLCs are required to file a state annual report. This report is essentially an information update of your file so that the state knows who is now in charge and how to contact your company. USA LLCs are also required to file state tax returns. To make matters even more complicated, your annual report and business privilege tax share a document and are due at the same time each year. With the IncFile's Gold package, you won't have to scribble notes of these reports because IncFile will handle the whole process for you. Your Platinum package also has these services in the bag with the unique addition of expedited filing, getting a domain name, and a business email, which essentially increases your LLC's credibility. IncFile also has an exclusive partnership with Bank of America, so you can easily open an eligible checking account for your business. Yes, it is a must for your LLC to have a business account. Remember, an LLC has limited liability, for it is a separate entity from its members. You may forfeit your liability protections if you combine your personal and business money, and this is where the term, piercing the corporate veil, comes into play. Piercing the corporate veil is an LLC jargon that refers to the court's action to hold you as the owner or member of an LLC, personally liable for the LLC's debts or actions. Now, if you have been sued by some lawyer who sees a crack in your LLC, they might resort to piercing the corporate veil in which you are in any position defeated. This is why opening a separate bank account for your LLC is so important. Do you like the level of detail I'm providing you in my review so far? If yes, then make sure to let me know by liking my video and hitting that subscribe button for more high-quality business content.